All right, let's just jump right into this explainer. We're looking at the H2 2026 outlook. And honestly, the economic landscape right now is completely polarizing. It's like we're caught in this bizarre tug of war. On one hand, indexes are just smashing record highs. But on the other, you can practically feel the unease in the air. We're going to break down exactly what's causing this massive tension and, more importantly, how we can actually navigate it. We're going on a macro to micro journey today. Here is what is actively reshaping the market. First, the macro fault lines. Second, the AI tug of war. Third, the AI infrastructure funnel. Fourth, FOMO versus corporate pragmatism. And finally, number 5, the great sector rotation. So let's kick things off with Section 1, the macro fault lines, focusing on sticky inflation and policy limbo. Because to really get what's happening in the stock market, we've got to zoom out and look at the physical world first. And that brings us to the big question. Why does the economy feel so stuck? I mean, despite Wall Street hitting these all-time milestones, there is a serious disconnect with Main Street reality. It is literally the #1 question on the minds of consumers and institutional investors alike right now. Well, the BBQ index hits the nail on the head here. We've got geopolitical shocks like the Iran war triggering this massive global volatility in oil and fertilizer supply chains. And guess where that trickles down to? Right to our grocery carts. Your weekend cookout is officially a casualty of geopolitics. We're seeing outsized pressure on energy-heavy perishables, driving the cost of a standard 10-person BBQ up a staggering 9.4% year over year. I mean, tomatoes alone are up 32%. Lettuce is up nearly 25%. Consumers are feeling genuinely squeezed, which is exactly why you're seeing companies like General Mills slashing prices just to try and meet them halfway. And because this inflation loop is just so structurally sticky, the Fed is holding a very, very strict line. Fed Chair Kevin Warsh actually came right out and warned that, quote, anyone expecting tolerance of greater than 2% inflation would be disappointed. So the huge takeaway for us, we can definitively cross near-term interest rate cuts right off our wish lists. This higher for longer environment is absolutely here to stay. To make matters more complicated, we've got massive policy uncertainty compounding that sticky inflation, and it's happening across both our physical and digital borders. On the physical side, we're looking at $1.6 trillion, yeah, trillion with a T, in critical USMCA trade pushed into this high-risk limbo. We're talking annual reviews, tighter rules on origin and investments, and simultaneously, on the digital side, we are entering a strict era of oversight for AI. The new administration is rolling out what is basically a de facto approval process and putting real restrictions on cutting-edge AI. The old hands-off, Wild West approach to tech regulation is officially a thing of the past. Okay, now that we've set the macro stage, let's zoom in on the micro, moving on to Section 2. The AI tug of war, boom versus overcapacity. This is arguably the most aggressive battle in the equities market right now. We've got a classic market showdown here. On one side, the bears are screaming about severe overcapacity. You've got famous investors like Michael Burry actively shorting chips, rumors floating around that Meta is selling off excess compute, and Apple's sitting at a PE ratio over 30 even with flat revenue. But then you look at the bulls. They are looking at an absolute earnings engine. The tech sector is projected to deliver a massive 58% earnings growth in Q3. That's being driven by this relentless enterprise demand and a sheer explosion of data that just flat out requires more infrastructure. So how do we actually turn this massive divide into an actionable strategy? Well, if the market is this fiercely divided, we need to ask, where is the smart money actually going? That brings us to Section 3. The AI infrastructure funnel, follow the money. This framework is a total game changer for cutting through the noise. It completely shifts our focus away from those flashy, kind of overvalued software layers and guides us straight into the physical picks and shovels of the AI build-out. The easy money phase? That's done. This funnel represents our new strategic reality. So let's break down this tiered strategy. Step 1, at the top of the funnel, you really want to avoid or just hold speculative hyperscalers. We're talking massive capital expenditures, unproven timelines, and these huge founder premiums. Think OpenAI or SpaceX. Step 2, start accumulating core infrastructure. Things like foundries and GPUs where the valuations actually still make sense. But step 3 is where the real magic happens. This is when you want high conviction, the long tail winners. Because of the insane volume of data storage and the literal hardware heat being generated, companies like SK Hynix in the memory space are up an eye-watering 685%. You're also seeing huge winners in liquid cooling and optical interconnects. It's wild. Now, moving away from the nuts and bolts of AI infrastructure, we really have to talk about human behavior. Let's look at section 4, FOMO versus corporate pragmatism in the attention economy. Okay, remember June 2026? We saw record retail trading driven by pure, unadulterated FOMO. Literally 9 of the 10 busiest retail trading days on record happened in that one single month. But as the SpaceX IPO data proves, hype almost never matches reality. Think about it. Shares went up 4x on day one and then completely round-tripped, plummeting below their opening price in just 11 days. That left leveraged ETFs deeply, deeply in the red. And the crucial takeaway here really boils down to this one powerful metric from Robinhood, negative 20. 20-day abnormal returns for trending stocks that retail buyers bought on day one are sharply, punishingly negative. The data just proves this simple, undeniable truth. Patience is statistically profitable, while attention-induced FOMO trading, it's pretty much a direct path to wealth destruction. So instead of chasing that IPO FOMO, we really should be studying corporate pragmatism. Kroger is a brilliant example of how smart companies navigate disruption. Just look at their resilience. When their massive $25 billion mega merger with Albertsons got blocked by regulators, they didn't panic. Actually, scratch that. They didn't just not panic. They immediately pivoted. They went for a highly targeted, highly practical $1.65 billion acquisition of Giant Eagle. Why? Because it lets them build regional scale in Ohio, Pennsylvania, and West Virginia to fight Walmart, all without setting off those federal antitrust alarms. It's a low multiple play projected to generate up to $100 million in synergies. That right there is the kind of quiet, strategic pragmatism we want to be looking for. And this perfectly tees up the final critical piece of our explainer today, Section 5, the Great Sector Rotation Q3 Flow. Let's see how all these macro fears and micro realities are literally creating a massive, systematic shift in capital right before our eyes. Just look at the stark divergence we're seeing here. It's wild. While the S&P 500 equal weight index is just steadily climbing upward to record highs, the semiconductor index took this brutal, massive single-session drop of over 6%. Guys, this isn't random volatility. This is hard proof that capital is actively, systematically leaving those established, crowded tech winners, and it's hunting for defensive value across the broader market. Don't get me wrong, tech is undeniably still the earnings leader. It surged 32% in the first half of the year. But because those stretched multiples make the sector so incredibly vulnerable to pullbacks, investors are just getting out. They're rotating. They're systematically broadening out into industrials, healthcare, financials, and energy, which, by the way, already gained a very quiet 20% in H1. They're seeking out better underlying value, especially since the U.S. economic base is proving to be so incredibly resilient. Because, look, the labor market remains solid. Job growth is holding strong at an average of 114,000 a month in 2026. The underlying economy is doing its job. But that easy money phase of just blindly buying tech, that is definitively over. This rotation is happening. It's real. So I'm going to leave you with this final, vital question to think about. As capital actively flows out of these crowded trades and moves into under-the-radar value, is your portfolio actually positioned for this new pragmatic reality? Are you still out there fighting yesterday's tug of war?